I've been through 12 recessions. 12. And I'll tell you something that most people never want to hear. Every single time I ended up wealthier on the other side. Not because I was lucky, not because I had some inside information, but because I understood something early in my life that took most people decades to figure out, if they figured it out at all. A recession isn't something that happens to you. It's something that happens for you if you're ready. Here's what most people don't understand. Right now, most people are watching the news. They're worried about their job, their rent, the interest rate on their credit card. And while they're focused on those things, the bigger picture is shifting underneath them. I'm not saying that to scare you. I'm saying it because I've watched this pattern repeat itself my entire life. The people who get hurt most in a recession aren't the ones who saw it coming and ignored it. They're the ones who are simply looking at the wrong things. In 2008, while the world was in full panic mode, I was busy. I deployed over $15 billion into the market during that crash, not despite the fear because of it. When people ask me how I did that, how I stayed calm when everyone else was falling apart, my answer is always the same. I prepared before the storm. The preparation isn't complicated, but it requires you to think differently than the majority of people around you, and that's the hard part. Let me explain something important. Think of wealth like a very specific game. It has rules, clear rules, but most people were never taught what those rules are. So they play anyway. They work hard, spend freely, stress quietly, and repeat. That's not building wealth. That's a treadmill. And when a recession comes and the treadmill stops, the people who understood the game weren't on that treadmill. They built something different, something that doesn't stop when the economy does, something that actually moves faster when others slow down. I've built that kind of machine over my lifetime, and in this video I want to show you how. There are 5 principles I've lived by through every downturn I've ever seen. They aren't complicated. They don't require a finance degree, but they will require you to think honestly about some things you might not want to look at. By the end of this, you'll have a clear, practical framework, not theory, that you can actually use starting today. But first, I want to show you why most people fail before the recession even arrives. I want to tell you about 2 people I've observed over the years. Same background, same income, same starting point. The first one, every time his salary went up, his life got bigger, nicer car, better apartment, more dinners out, bigger vacations. From the outside, he looked successful, and honestly, he felt successful. The second person, every time her salary went up, she sat on her hands. Her lifestyle barely changed. She put the extra money somewhere quiet and waited. Now nothing happened for a while. Both were doing fine. Then the economy softened, hours got cut, companies started tightening up. The first person panicked. His expenses had grown to match his old income. He had almost nothing saved. He started missing payments. He sold his car for less than he paid for it. He was underwater, and the water was rising. And the second person, she was calm. She was looking for undervalued real estate, looking for good companies whose stock had gone on sale. She was in a position to act while everyone else was just trying to survive. Same income, same starting point, completely different outcome. I call this the liquidity trap, and I've seen it more times than I can count. Here's what most people don't understand. Lifestyle isn't wealth. Lifestyle is a cost. The more your lifestyle grows, the more exposed you become when conditions change. Because conditions always change. That's not pessimism, it's just history. I've kept large amounts of cash ready my entire career, not because I didn't know what to do with it, but because I was waiting for the moment when someone who was overextended needed to sell something valuable at a price that reflected their desperation, not the actual worth of the asset. That moment comes in every recession, every single one, and I've learned that the investor with cash and patience will always outperform the investor with ideas and no options. But here's what I want you to really sit with. Liquidity isn't just a financial position, it's a psychological one. When you have a real cash cushion, something you can actually live on, your thinking clears up. You stop reacting, you start seeing, and clear thinking during a recession is worth more than any stock tip, any trend, any prediction. So if I were in your position today, the first question I'd ask myself is this: if my income stopped tomorrow, how long could I last? That number tells you exactly how much risk you're carrying right now. The second principle will show you what's quietly making that number smaller every single month. Let me say something about debt that I think most people have never really absorbed. Debt isn't a balance on a screen. It isn't a monthly payment. Debt is borrowed time from your future. Every dollar you owe has already been spent. It's gone. You just haven't done the work to pay for it yet. I've seen more people fail because of leverage than almost anything else in my life, and the reason isn't that they borrowed too much in one dramatic moment. It's that the cost of debt compounds quietly every day in the background, and most people never stop to calculate what it's actually taking from them. Here's a simple example. You put $4,000 on a credit card at 22% interest, you make minimum payments. By the time that balance is gone, you've paid back over, and here's the part that most people miss entirely. That money wasn't just spent, it was stolen from your future. Every dollar going toward interest is a dollar that isn't compounding, that isn't building, that isn't working for you. I've talked about compound interest my whole life as the great wealth builder, but compound interest works just as powerfully in reverse. With debt, it compounds against you quietly, relentlessly, every single day. Now here's why this matters so much heading into a recession. When the economy turns, income often drops. Maybe your job changes, maybe your business slows, maybe your hours get cut, your income gets smaller, but your debt doesn't get the memo. It keeps charging. Same rate, same schedule, no adjustment. So people enter a recession already behind, already bleeding from a debt they couldn't see, and then their income falls on top of it. That's not a tough stretch, that's a spiral. I've watched it happen to smart, hardworking people who simply never thought carefully about this. If I were in your position today, I'd be honest with myself about every debt I carry, not to judge myself, but to see clearly, because the people who come out of recessions ahead are usually the ones who went in lean, not because they earned more, but because they owed less. Less obligation, more freedom, more options. And what I've found is this: the less you owe, the more clearly you think, and the more clearly you think, the better you act. Which brings me to something that most people never even recognize as a financial problem. This one is quieter than the others. You won't find it in any financial textbook, but in my experience, it might be the most powerful force keeping people from building real wealth. I call it the consumption identity. Here's what I mean. At some point, usually slowly, usually without noticing, people begin to define themselves by what they own. Their car says something about them, their apartment says something, their clothes, their phone, their vacations. These stop being purchases, they become identity. And once that happens, cutting back stops feeling like financial wisdom. It starts feeling like loss, like becoming someone less. I've seen people earning very good money who couldn't save a dollar, not because they couldn't afford to, but because every dollar was tied up in maintaining a version of themselves. The raise got spent before it arrived, the bonus disappeared into a lifestyle upgrade, the gap between earning and keeping never closed. And what nobody ever tells them is what none of that is weakness, that's design. The consumer economy is very, very good at connecting your sense of self-worth to your spending. Advertising doesn't sell products, it sells belonging, it sells identity. It says, buy this and you'll be this kind of person, and it works. I understand this as well as anyone. I studied it as a young man. I read every book I could find on human psychology and behavior, and here's what I've come to believe after a lifetime of watching it. The wealthiest people I know don't identify with their possessions. They identify with their principles, their patience, their long-term thinking. I've lived in the same house since 1958. I paid $31,500 for it. I drive a modest car. I eat breakfast at McDonald's most mornings. Some people think that's eccentric. I think it's freedom. When your identity isn't tied to what you spend, nothing can take it from you. Not a recession, not a market crash, not a job loss. You stay yourself, you stay calm, you stay in the game. And that leads to something I've thought about deeply for a long time. If you stripped away everything you own tomorrow, and the car, the apartment, the things you buy to feel okay, would you still know who you are? That's a serious question, and the answer tells you more about your financial future than any spreadsheet can. Because the next principle is about how your environment is either building that kind of person or quietly working against you. I want to talk about something that doesn't get enough credit in personal finance. Most of the advice out there is about willpower. Spend less, save more, try harder, be more disciplined. I understand the appeal of that message, but I've never found willpower to be a reliable strategy. Not for myself, not for anyone I've observed closely. Willpower runs out every day under stress, under fatigue, under social pressure. The people I've seen build real lasting financial discipline over decades didn't do it through force of will. They did it by designing their environment so the right behavior was simply the easiest behavior. I call this environment architecture. Here's what it looks like in practice. If every time you get paid, the money lands in your checking account and sits there, you'll spend it. Maybe not all at once, but gradually, naturally, without drama, it'll go. But if the day you get paid, a portion automatically moves to savings before you see it, something different happens. You adapt to what's left. Your spending adjusts downward and the savings builds without requiring any willpower at all. The decision was made once at the system level, and then it runs on its own. That's the architecture. Now here's the part that most people overlook. Your social environment matters just as much as your financial systems. I believe for a long time that the people you spend time with shape your financial behavior more than almost any other factor. Not because your friends are bad people, but because humans are wired to mirror the behavior of the people around them. We adjust to the norms of our group. It's natural, it's ancient. If the 5 people you spend the most time with spend everything they earn, you'll find reasons to do the same. If they think about the future, talk about building, take a long view, you'll naturally move in that direction. This isn't a theory. I've watched it my entire life. I was fortunate to have mentors early on, people like Benjamin Graham, who showed me what disciplined, patient thinking looked like from the inside. That changed everything about how I operated. So if I were in your position today, I'd think carefully about both kinds of environment: the financial system, savings, automation, debt reduction, investment defaults, and the human environment and the voices you listen to, the communities you're part of, the people you admire. Both of those are shaping your outcomes right now, whether you design them or not. And the last principle ties all of this together, because even with perfect systems and a strong environment, there's one more force working against you. It's the quietest one, and in 2026, it's louder than it's ever been. I want to describe something I think of as the attention economy tax. Here's how it works. Every platform, every news channel, every app on your phone, they all have one thing in common. They profit from your attention, not from your well-being, not from your financial health, from your attention. And the fastest, most reliable way to capture your attention is fear. So the news isn't just reporting what's happening, it's amplifying the most alarming version of what's happening, because alarming keeps you watching. Watching keeps the advertisers paying. I've been very deliberate throughout my life about where I direct my attention during downturns. When markets fall, the headlines get louder, the predictions get more extreme, the urgency becomes overwhelming, and people react. They sell when they should hold, they panic when they should think, they make permanent decisions based on temporary emotions. I've seen this happen in every single recession I've lived through, and in every single one, the people who reacted to the noise paid for it. Here's what I do when the noise gets loud: I turn it off. I go back to the fundamentals. What is this business actually worth? What will it be worth in 10 years? Is this a real lasting problem, or is it fear presenting itself as a problem? Most of the time it's the second one. The market is not a weighing machine in the short term. It's a voting machine, and during recessions it votes based on fear. But fear passes, value remains. The tax I'm describing isn't money taken from your bank account. It's something more expensive. It's clarity taken from your thinking. It's patience taken from your decision-making. It's confidence taken from your judgment. And in a recession, clear thinking is the single most valuable asset you can have, more valuable than cash, more valuable than the best stock tip, because every great financial decision I've ever made came from a place of stillness, not from reacting to what everyone else was doing, from quietly asking, what do I actually know to be true here? That's the discipline I'd want you to build before the 2026 recession arrives, not just the financial systems, not just the debt reduction, the ability to stay quiet when the world is loud, to think slowly when everyone else is moving fast, to act, but only when you've thought it through. That's what separates the people who harvest in recessions from the people who simply survive them. And now I want to walk you through exactly what to do. Everything I've shared comes down to 4 steps, not theories, not motivation. 4 concrete things you can actually do in the right order. Step 1, awareness. See where you actually stand. The first step is the most uncomfortable, and it's the one most people skip. They have a general sense of their finances, a rough idea. They don't want to look too closely. I understand that impulse, but I've never seen a financial problem improve because someone looked away from it. This week, sit down and build the full picture. Every monthly expense, every debt, the balance, the interest rate, the monthly cost, every subscription, every automatic charge. Then ask yourself one question. If my income stopped tomorrow, how many months could I last? If that number is less than 6 months, that is your only priority right now. Not investing, not finding the next opportunity, not optimizing anything. Building a 6-month cash cushion is the most powerful financial move you can make before a recession, because you can't think clearly when you're desperate, and you can't be patient when you're in survival mode. The cushion buys you the one thing that matters most in a downturn: time to think. Step 2, control. Align your systems with your goals. Once you can see clearly, you build. Go back to what we talked about with environment architecture. Automate your savings. Set it up so the money moves before you touch it. Automate your investment contributions if you have them. Remove friction from the things you want to do more of. Add friction to the things you want to do less of. Then go back to the consumption identity. Ask yourself honestly where spending is tied to your sense of self. Not to judge it, just to see it, because once you see it, you have a choice. Before you see it, you don't. Then attack your highest interest debt, not the largest balance. The highest interest rate, that's where the debt accelerator is running fastest. Cut the power to it first. Control means your systems are working for you even when you're tired, even when you're stressed, even when the news is loud. That's the only kind of control worth having. Step 3, growth. Position before the opportunity arrives. Here's the part I enjoy most. When asset prices fall, and they will, that most people experience that as loss. I experience it as a sale. The business doesn't become worth less because the stock price goes down. The property isn't worth less because the market is panicking. Price and value are different things. That's the most important financial distinction I know. And a recession is the single best time in a decade to buy good assets at prices that reflect someone else's fear rather than the actual value of what you're buying. But you can only do that if you prepared. Emergency fund in place, high interest debt reduced, cash available. If those aren't in place, you'll be one of the people selling, and I'll be one of the people buying. That's how wealth transfers in recessions. It's not random. It's a direct result of who prepared and who didn't. Step 4, freedom. Remember what this is actually for. The last step is the one most financial advice forgets. Money is not the goal. I've known people with enormous wealth who weren't free, and I've known people with very modest means who were completely free. The difference wasn't the number in the account. It was whether the money served their life or whether they were serving the money. The best investment I ever made wasn't in a company. It was in my own thinking, in reading, in studying, in understanding how businesses and human behavior actually work. That investment compounded for decades, and it never went down in value. What I want for you, and the reason I'm sharing all of this, is not a bigger portfolio. It's a life where you wake up and your systems are working, where your decisions come from clarity, not desperation, where a recession feels like an opportunity rather than a threat. That kind of life is built slowly, deliberately, one decision at a time. Let me bring this together. We talked about the liquidity trap, the danger of confusing a growing lifestyle with growing wealth, and why cash above all else gives you options when others have none. We talked about the debt accelerator, how compound interest works just as powerfully against you as it does for you, and why entering a recession with low obligations changes everything. We talked about the consumption identity, how spending becomes wrapped up in self-worth, and why the most financially resilient people I know identify with their values rather than their possessions. We talked about environment architecture, where why willpower alone will never be enough, and how the right systems and the right people around you will do more for your financial life than any amount of discipline. And we talked about the attention economy tax, how fear-based media extracts clarity from your thinking, and why the quietest investors in the room are almost always the most successful ones. 4 steps: awareness, control, growth, freedom. Here's what I want to leave you with. I'm not nervous about what's coming, and I don't want you to be either. Nervous is for the people who didn't prepare. Readiness is for the people who took the time before it was urgent to build something solid. The wealth gap that forms during recessions isn't created during the recession. It's created in the months before, in the quiet moments when someone decides to look at their finances honestly, when someone chooses to build a cushion instead of upgrade their lifestyle, when someone decides to understand what's happening instead of just reacting to it. Those decisions, small, unglamorous, undramatic, are the ones that separate the outcomes. I've lived through enough history to know this with certainty. The people who came out ahead were almost never the ones with the biggest income or the hottest investment. They were the ones who stayed calm, who prepared, who understood that a downturn is just a different kind of market, and that every market, including the difficult ones, has opportunity in it for the person who's ready. You can be that person. The principles are simple, the framework is practical, the work is yours. Start today.